Now to our first newsmaker of the hour, Minneapolis Fed President Neel Kashkari. Our own Steve Leisman is joining us on set for this conversation as well. But Neel, first of all, thank you for coming into set today. It's great to see you.
Great to see you. Congratulations on your spinoff.
Thank you very much. Everybody's waiting to see what the Fed does this year, what happens. And I know you've been pretty clear that it's going to be a data-dependent situation. You don't think the Fed should be automatically making moves any direction or another. So let's get right to what you think about, first, the jobs market and second, inflation. Where do you see things right now?
I mean, the job market is clearly cooling. There's no question about that. We see this in the national statistics. The unemployment rate is up now to around 4.6%. I think that's a real, there's a lot of questions on some of the data. I think the unemployment rate is pretty clean at 4.6%. When I talk to businesses in my region, they also say they're not hiring very much. So I think that that's a clear signal that the labor market is cooling. At the same time, inflation is still too high. I think the most recent inflation data, I don't take that seriously because there's some issues with the data collection, with the shutdown. I think inflation is still too high. And the big question in my mind is, how tight is monetary policy? Over the last couple of years, we kept thinking the economy is going to slow down, and the economy has proven to be far more resilient than I had expected. That tells me, well, monetary policy must not be putting that much downward pressure on the economy. And so my guess is we're pretty close to neutral right now, and we just need to get more data to see which is the bigger force. Is it inflation or is it the labor market? And then we can move from a neutral stance, whatever direction is necessary.
But your gut tells you right now that the labor market is maybe the bigger issue to wrestle with at this
Probably. I don't think we're going to be surprised that inflation ends up being much higher than we are seeing right now. I think the inflation risk is one of persistence, that these tariff effects take multiple years to work their way all the way through the system, whereas I do think there's a risk that the unemployment rate could pop from here.
Well, that's really weird then, Neel, because we've been above 2%, 50% above 2% for 2 years then. The Fed has totally missed that target, and we've just cut 4 or 5 times. So that makes no sense. Then you've moved the goalpost to 3%.
No. I don't think we have moved the goalpost at all. I think the debate that we've been having at the committee is, we know that tariffs affect goods import prices. Do you count that as a one-time effect, or do you think it leads to something more persistent? That's the debate that we've been having.
Right, but the persistent inflation hasn't really had anything to do. It was already persistent long before the tariffs.
Because of the COVID effects. I agree with you, Joe. I mean, that's why it's not. Some people say it's so obvious we should be ignoring tariff inflation. Inflation's on its way back down, and just be cutting dramatically to support the labor market. I'm not there either.
But if 2 was really your target, you wouldn't have cut at all.
Well, we have two sides of our mandate. Right? Inflation is slowly trending down. The unemployment rate has gone from 3.6 to 4.6. Right. So we're moving in the wrong direction on the labor market. We're slowly moving in the right direction.
I mean, I'm just devil's advocate. I wish rates were zero. I wish you could pay me to take oil, and I wish the bank would pay me the mortgage for my house. But
doesn't work that way in a capitalist system.
It depends, as you now know. Capitalism. Yeah, it all depends. No, I'm just kidding though, but because it almost looks like a critic of the, and we're talking about critics this morning, but we're not really being ourselves. But a critic would say that the Fed has moved the goalpost.
No, I hear you. I mean, it's been 5 years now.
But I don't say.
No, but it's been 4 or 5 years with substantially elevated inflation.
Yeah.
That we should all be alarmed about.
But you blamed it on the pandemic, not on all the stimulus.
Well, I think it's a combination of a bunch of factors. I mean, when I say pandemic,
cause of stimulus.
It's pandemic, it's stimulus, it's Russia invading Ukraine. All of these pushed in one direction, which is prices up.
Neel, can you walk us through your outlook for next year? Does inflation come down slowly? What happens to the unemployment rate, and what do you do with growth?
Yeah, well, growth is the one that we talked about a moment ago, which just keeps surprising me how resilient growth has been. My expectation is the economy will probably continue doing what it's been doing, which is pretty resilient, pretty decent growth. Now, in terms of the inflation components, now we have to go under the hood. I've got a lot of confidence that housing services inflation is coming down. We've modeled out the mechanism from new rent growth all the way through CPI, through PCE for inflation. So housing services inflation, I've got confidence, should continue to come down. The non-housing services, it should be tied to wages, and wage growth is slowly trending down. So it's going to be slow, is my bottom line there. The tariff-induced goods inflation, are we going to see a repricing in January of this year? A lot of businesses have said there could be a repricing this year as they reset prices. That's something that we're going to need to watch. On the labor market, my expectation is continued low hiring, but low firing. A lot of businesses that I talk to say that they are using AI, big companies are using AI. It is affecting their hiring plans as they're trying to deploy AI. So my guess is unemployment rate moving more or less sideways, inflation slowly trending down.
So that's the policy side. What about the makeup of the committee? We were talking on Friday about whether or not Fed Chair Jay Powell stays on. What's your expectation?
Oh, I have no idea what he stays on. I think he's done a wonderful job as chair. None of us are perfect. I think he's not perfect. I'm not perfect. As a committee, we're not perfect. But overall, I think he's done an excellent job. And I would love to see him remain as a colleague for as long as he likes.
You would. One of the concerns about the makeup of the Fed with appointees from the president is that they would have the power to fire presidents. Are you concerned about, you're the president of the presidents, right? You're the head of the president's committee. Is that what you call it?
Yeah, the conference of chairs.
The conference of chairs, okay. Are you concerned that presidents could be fired individually for lack of cause?
I'm not concerned about that. I think that the Federal Reserve Act is built on a foundation of 12 independent Federal Reserve banks. We each serve, all the presidents serve at the pleasure of our local boards of directors. The local boards of directors have the power to oversee me, to remove me. That's where the power lies, as opposed to in Washington.
You're on the board of the Economic Club of Minnesota.
I am.
True?
Of course he is.
I hear Secretary Bessent's going to be speaking. Is this a real economic club or just a facade? Why
would it be a facade?
You just get big grants for the club and nothing actually. It's in Minnesota, right?
I see.
So you see where this is going.
I see where this is going. I see where this is going.
Do you do anything there? If someone goes there and tries to see if anyone's inside, are they going to say?
It's a very lean operation. We have 2 employees.
Are you excited that
we have 2 employees?
Is it a Leering Center? Are you excited about the?
Yeah, I learned about it last week. The Secretary Bessent wanted to come address the club, and we're going to be hosting him on Thursday.
That's very good.
But one of the things Secretary Bessent has complained about is this notion of Fed bank presidents being from outside of their regions. Is that a real reason for concern?
You know, the Federal Reserve Act created the 12 reserve banks, specifies that the reserve banks each have boards of directors of local leaders, and those local leaders are charged with selecting the president. So 10 of the 12 of us have come from outside our immediate district.
So he's right.
Well, he's right that we've come from outside of our districts. I don't agree that we don't represent our districts well. You know, I've been in Minnesota now for 10 years. I'm very well known across the region by business leaders and by civic and elected leaders. And I think that those judgments are best left to the local districts to decide who should lead their banks.
Neel, let's go back to what you're hearing from your local businesses. You said big companies are slowing down their hiring because they're trying to figure out how to implement AI. What do you hear from smaller companies?
Not AI. AI is really a big company story, at least what I'm hearing. Small companies are feeling a lot of pressure, even from the big companies. The big companies that I talk to that have retail exposure have told me that they see their lower income and their middle class consumers acting as though it's the recession. Like they're trading down, where they're shopping, they're penny pinching, and that gives them real concern about, hey, these folks are feeling real pressure. And small businesses, a lot of them do serve families and consumers in retail. So I think that they're feeling that pressure as well. You know, we've talked all year about the K-shaped economy. That seems to still be ringing true in our region.
The Fed has a tool, a very blunt tool to try and combat that. That's lower rates. What it also happens to do, along with helping people who are trying to get credit card payments or house mortgages or anything along those lines, is inflate assets, stock market assets, equities. And those assets, while they're pretty broadly held by by a majority of Americans, do tend to help the wealthiest the most. Are you okay with using that tool to blunt what's happening to the lower demographics and not worry about what happens on the upper end with those assets? You know,
it's a very fair point you're raising, and something that I do think about. It's even more complicated than I think what you just said, which is if you think about the lower income middle class family, why are they feeling so much economic anxiety? It's because of inflation. Most of them still have their jobs. So if we say, well, we want to cut rates to help lower income families, and that might help their job prospects, but if it pushes up inflation or keeps inflation high for longer, is that actually helping them or not? So it's a intellectual question. Can monetary policy help boost real wages? Mm-hmm. It's a tricky dynamic.
there's a possibility that the tariff story gets re-scrambled in the next couple weeks when we hear from the Supreme Court. I don't think we know what we're going to hear, but there's a possibility that they either overturn them or say prospectively they can't be done this way. Then you're going to see, I imagine, the administration try to pursue them in a different fashion. I know you can't make judgments about what's going to happen in the future, but part of your job is to make judgments about what happens in the future. So how do you think about that?
I think what you said I agree with, which is it seems like the administration has said they will use other mechanisms to try to get to the same place. I feel like right now we're in a good trajectory where we're approaching some type of equilibrium on the tariff and trade front, which is what businesses are asking for. I think the re-scrambling will be unfortunate because it will cause a lot of uncertainty about which tariffs are sticking and which ones aren't. So I would be surprised if it leads to a new trade war, but I do think it could lead to a burst of uncertainty, which is going to be a damper on the economy.
Neel, that last nominal GDP number was like unheard of. What about 2026? Let's think about some of the tailwinds, whether it's regulatory or things in the big, beautiful bill that are coming through for businesses or tax relief.
Can I interpret, Joe? Your nominal is your real plus the inflation, and it was
like
8%, right?
8%. That's unsustainable.
It's a big number.
It's a big number.
Is it not? What do you think real GDP can be for 2026? What would blow you away and what would not? Could it be 2%? Could it be 5%?
2%, sure. It could easily be 2%. I'd be very surprised.
You negative nabob of negativity. Could it be 4%? Could it be 3%?
We could be surprised at 3%. You know, the part of the things you just said that are very hard to analyze and to quantify.
AI.
Well, AI, but deregulation.
Deregulation.
There's a lot of talk about deregulation. A lot of businesses are excited about it. How do you quantify it? How much deregulation
and could it be good, and could inflation do maybe not? Could it stay where it is? I mean, we could be in a pretty good spot.
A lot of people make comparisons to the mid-'90s in terms of the productivity environment.
Remember? Yeah.
And we hope we're in a high productivity environment going forward. The mid-'90s, a lot of productivity probably means a lot of investment, probably means high rates. So in the mid-'90s, we had a 5% federal funds rate, and that was not considered to be a very high federal funds rate. And so, you know, we could be in a strong growth environment, but rates may not be going down from here.
Neel, you cut your chops where I got to know you in government, in the Treasury in 2006, which was a great time to come in because it led directly to 2008.
It was good for a while.
It was good for a while. It was a run there, just a short while. Right now, when you look around the financial landscape, are there things that concern you, either like 06 or maybe more importantly, different from the 08 situation that are high on your radar in terms of concern about risk?
Well, I mean, a better place that we are is I do think American households are in much better fiscal position than they were 20 years ago, much less levered than they were, more housing wealth, for example, even though home prices are ticking lower. So I think that they're in a better, stronger financial position. And then there's been a ton of attention about private credit. You know, we'll have to see. They're generally much less levered than banks. So even if there are issues in the private credit sector, I don't see that leading to a 08 type crisis.
I got two more questions, guys. The AI investment.
Yes.
Is that something that if it doesn't work out is a risk you have to be careful of?
I mean, there's no question that there's some misinvestment or malinvestment that's going on, but there are too many anecdotes of businesses using this and actually seeing real productivity gains. Businesses that I talked to that 2 years ago were skeptical are saying, no, we're actually using it now.
Now, finally, I know you don't have an international brief, but what happened with Venezuela over the weekend? How does something like that come onto your radar in terms of your outlook for the economy and policy?
Mostly through oil prices. You know, when Russia invaded Ukraine, it sent a commodity shock wave all around the world.
Right.
It didn't happen with Hamas attacking Israel. It has not happened now with the U.S. and Venezuela. But that's the mechanism that it would directly affect the U.S. economy.
Do you see it? You don't see it?
I don't see it so far.
Okay. You embarrassed to be from Minnesota at this point?
Not at all. Proud to be from Minnesota.
All right. You'll get your act together.
You're all invited to come visit.
Yeah?
Come visit us.
Thank you.
Neel Kashkari.
In February.
Thank you very much for joining us today. We appreciate it. Steve Leisman, thank you.